Yeah, so there are some 2 theory questions, then we'll start with the practical questions. This is of the uniform policy. PQR is the subsidiary of MNC. In the individual financial statement prepared as per the Ind AS, PQR adopted SLM basis and MNC, who is the parent, adopted WDV method. Now, as per CFS, they should prepare the CFS using same accounting policies. How the PP will be depreciated in the CFS, whether it is a WDV or SLM basis? See, now your parent is doing WDV, subsidiary is doing SLM. So they are asking you in CFS, when you take a subsidiary's asset, should you continue depreciating it WDV basis or SLM basis, or to change it to WDV? SLM. That's what they say, that a change in accounting depreciation is a change in estimate. What your Ind AS 110 says, you need to have the same accounting policy, not a estimate. So they may follow different methods of depreciation depending upon whatever consumption pattern of the asset. So subsidiary can depreciate using SLM and parent can do it WDV basis. Whatever method they choose, it should reflect the pattern of consumption. Next question. H Limited has a subsidiary S and A, associate A. 3 companies engaged in different lines of business, not in the same business. H is following, parent is following FIFO, whereas a subsidiary and associate following weighted average. Now, whether H is required to value the inventory of S, A Limited valuation of inventory doesn't come into picture because you are an associate. I don't consider your inventory. Using FIFO formula. No, again it is a member 110 says that you have to follow the same method, otherwise you have to make the adjustment. So as per AS2, Ind AS2, it is an accounting policy. However, depending upon the type of inventory, you can have a different policies. So it should be similar nature, like same inventory in both the companies, but we said that the parent and subsidiaries are in different lines of business. So it can be possible that you can use different cost formula at a CFS, provided you are in different lines of business. You are in the same line of business, like crude oil is there. ONGC and MRPL have to follow the same method, like ONGC FIFO, MRPL weighted average not permitted. So if crude oil, if MRPL is following in weighted average in the SFS, let them do it. But when it gets consolidated, you have to revalue it FIFO. That's the generally the parent and subsidiaries will follow the uniform accounting policy. Otherwise, headache, no, one more headache. M Limited holds 90% interest in subsidiary N Limited, and N Limited holds 25% in O Limited. Oh, that means I have got an M, I hold 90% in N, and N is having an associate with the 25%. The net assets of O is 300 lakhs. You remember similar question we had done. Then one of the N sold their subsidiary associate or revalued something. How much profit parent should recognize in share of associates? Calculate how the investment of O Limited will be accounted in the CFS. So what you should do, you will show full 100% of the investment. But when it comes to the share of profits, we will distribute it to OCI and U. NCI and U. Okay, see, N is the subsidiary of M, but it is not 100%. It is 90%. So CFS will include 100% of the asset. That means if you have got an investment in O, I will show full 100% of the investment, even though I don't own that 100%. Further, N share of profit, when it comes, it should be distributed in the ratio of 90:10. This is what we discussed. Okay. Presentation wise, when I say assets, non-current assets, financial assets, how much is my investment in O? Net assets of O into 25% as per Ind AS 28. That is not my asset, my subsidiary investor. But when it comes to SOC, how it is presented? Share of profits of O, for my retained earnings 9 will go, 40 crore profit into 25% into 90%. And in my subsidiary, because this is not my investment, no. If see, instead of M is holding in N, M only holds in A, then I would have taken full 100%. because I am holding myself. But I am holding in an associate through a subsidiary, and that subsidiary is not 100%. Then I will take my share of profit, which is 40 into 25% into 90%, and balance 10% I will address to NCI. Because in N there are two people, no, 90% I own, 10% NCI. That means if I take the share of profits of that subsidiary, I'll give to some portion to N. Theoretical question. Yes, so finally we'll come to the problems part. So initial problems. Okay, so we'll talk about the calculation of the goodwill. We have done the master problems on this. So we'll not spend time. I don't think so. We have to work also. A Limited acquired 80% by paying cash of 120. Fair value of the NCI is 30. Value of the net assets is 130. What is goodwill, and pass the journal entry? Simple. No? We need not calculate also. By looking at the problem only, we know that there are two methods of valuation. If I go for the fair valuation, I will take this. If I take this, otherwise, and deduct the net assets, I get 20 and 16. So I'll proceed further. Okay, no? No, again in your Ind AS 110 also, they start with the goodwill workings. Just to remind you, okay, so then Ram Limited acquired 60% of Raja by paying cash of 7. Okay, no, you want to solve this? Journal entry we know, no. Net assets account debit, goodwill account debit to NCI to purchase consideration cash. Yeah, this is our 1 or 3 things. So I will just proceed further. I will not spend time. That's what I'm trying to tell you, because we have solved further questions of this. Ram acquired 60% of Raja by paying cash of 750, including control premium. The fair value of NCI is 480. Subsidy is identified assets is 100. What is value of the goodwill? 2. Okay, so you have paid 750 plus goodwill to be valued, fair value only they have told 480 minus 1000. Okay, here also two methods of valuation, 750 plus 480 minus 1000, 230 versus 750 plus 400. If you follow proportionate net asset, minus 1000 gives you 150. Including control premium means this 1000 includes your whatever, 750 what you paid, it includes control premium. That means something more than its worth. That is, this is primarily the goodwill. See, if you see, for example, if I follow this method of, do I have any goodwill here for the NCI? No, because this is the value of the asset I got. This is the proportionate NCI I reduce. That means if I take, say, 80% of this net assets, because how much is my holding? Sorry, not 80%, 60% of this minus purchase consideration, that 150 is sitting here, which is control premium. 150 is called control premium. Are you clear about this language? So journal entry also we have seen now, how to pass the journal entries, we know that. Okay, I'll proceed further. And if I follow the purchase net asset, proportionate net asset method, this will be my journal entry. X acquires 80% of Y by paying cash of 400. Fair value of the NCI is 100. Subsidiary is 520. What is the value of the bargain gain and pass journal entry? Sorry, how much? 20 and 16. Okay, now we have got a bargain gain, so it will be a credit, and we have to say we have to have an evidence to recognize this bargain gain. Okay, I'll proceed further. M Limited acquire 100%. Yeah, because generally, no, I would not have done. This I would have done sometime later. So here I am doing immediately after 103. That's why it's very fresh in mind. As a warm-up exercise, no, we should do this. I should do in the previous sessions. M acquired 100% by paying cash of 100, 80. So 20 is my goodwill. No NCA coming into picture. Yes, that's it. Now, let us talk about the elimination of unrealized profits. A parent owns 60% of the subsidiary, and subsidiary sells some goods to inventory to parent for 35,000 rupees and makes a profit of 15,000 rupees on sale. Now, this is an upstream or a downstream? It's an upstream, and the inventory is in the parent's balance sheet at the end of the year. That means you didn't sell to third party. So when you consolidate, your inventory of the subsidiary is sitting with the parent with the profit loaded on it. So you have to remove unrealized profit. So, but they say examine the treatment and pass the entry. See, when they say examine, we have to look into the component what exactly it is. So, right, solution. Okay, we'll start with the question number 5. This is an upstream transaction, and how much is my profit? URP is 15,000. Now, should I allocate only to the parent or parent and subsidiary? Okay, this is allocated to parent and subsidiary. See, students, why I am telling you now? See, if I take you look here, because in Ind AS 28, when I took my share of profit of the associate, did I pass any entry? From the associate, when I took my share of profits, did I pass any entry? In Ind AS 28, there is one associate. That associate made a profit, and I took my share of profit. Did I pass any accounting entry? Huh? What entry I passed? No, forget about the stock elimination and all. When I took my share of profit, what accounting entry I passed? Investment account debit to share of profit. And that share of profit I will show in my P&L. But see, such type of entries I cannot pass with the subsidiary. Understand why? Because see, in case of associate, there is one associate P&L. That associate P&L will have one P&L profit. So I will take my share, say 20%, and I'll pass the entry investment account debit to share of profit. And this share of profit I will share in my P&L account. But in case of subsidiary, I cannot pass this entry for share of profit. I showed you in my format. In my format, I showed you, share of profit. No, it doesn't come that way. Why? Because, see, subsidiary has got a P&L. My parent has got a P&L. I will consolidate line by line. No, I cannot pass one entry here. Their sales, I will add it with my sale. Their expenses, I will add it with my expenses. In this process, their profit automatically comes in my consolidated profit. In respect to my, that's called line by line consolidation. Their finance cost will be added with my finance cost. So it's not that one profit I will take and pass one accounting entry. That doesn't work that way. Separately, I have to prepare this, take this subsidiary, do the fair value adjustment, and take the NCI portion, pass one entry called share of NCI, share of profit account debit to NCI, and then deduct that share of profit from this consolidated profits. I have to do a separate calculation how much I need to give to NCI, because for this will I give NCI, here there are two things, 80% held by me, 20% held by this. Will I give a share here in 80-20? No. This includes two elements, my profit, my subsidiary's profit, because of line by line consolidation. That's why I separately calculate subsidiary's profit with the fair value adjustment. There I make two bifurcation. This 20% I give to them. How? By crediting them and deducting it my share of my consolidated profit, my P&L. No, fair value adjustments are there. No, otherwise we can do it like this. For this, you do all fair value adjustment, one more column. This profit you take 80-20, 80 you straight away take. But problem is it's not line by line consolidation. You will miss the line by line consolidation. Understood, no? So line by line means it all, that's, see, why I should tell you, because if I show you the entry, no, you may get confused now. It's not like your associate entry. Okay, so have you written this? So to eliminate, should I not eliminate now? And you said you should allocate both to parent and NCI. Can you tell me what will be my accounting entry? Sales I should debit. Okay, debit consolidated sales account to consolidated COGS. How much consolidated sales I will eliminate? 35,000. Because how much sales is sitting in the subsidiaries P&L? 35,000. How much purchase is sitting in my P&L? 20,000. 20, no. He has sold it, okay. Okay, I'll tell you. So write COGS, consolidated COGS 20 to consolidated balance sheet 15,000. Now you are not convinced with this, correct? No, okay, no problem. I'll explain, don't worry. Now this entry is there in the institute's material. I know your only doubt is with regard to this, if at all it is there. Let me show you. First of all, this entry I showed you, why? Because this is ICA is passing like this, and it is going to reduce, and they said that the reduction of the gross profit of 15,000. Now this results in reduction of the profit, no, in P&L level. Is it allocated between parent and company in the ratio of 60-40? Forget it, not required. Now understand, did you pass subsidiary pass this entry? Purchase account debit, intercompany sales 35. In the parent's P&L, intra-company purchase 35, closing stock 35. Now, if I consolidate both, it will look like this: purchase 20, intra-company purchase 35, intra-company sales 35, closing stock 35. So, in a consolidation level, I make a 15,000 rupees profit. But I didn't make, no, Baba. It is nobody's profit, no. It's the profit of SFS, but at the CFS level, it's nobody's profit, because me and subsidiary are one. That's why I will reverse intra-group purchase to intra-group sales. This is my intra-group transaction. I will reverse it. Then closing stock, it is overvalued, no? I will reduce the closing stock COGS and reduce the closing stock of the balance sheet, because what is my closing stock entry? What entry parent I have passed here? Arre Baba, see, first of all, you purchased. What entry you passed? Purchases to subsidiary. Okay, one leg is sitting in the balance sheet, because outstanding payable to the subsidiary. Subsidiary is your creditor. At the end of the year, did you sell it? No. You went and counted. Was it that physical stock available? Yes. Should you not bring it into P&L account now? What entry you passed for bringing a physically existing closing stock? You can call it by that. Okay, it's like a COGS entry. So the moment you have count the closing stock, no, in effect, what is the entry sitting? Entry is inventory account debit to COGS. You said we'll purchase, bring this side, no. You said purchase, not said you will bring it on the you bring it on the liability side, means can I say COGS is credited? No. Again, Ind AS 2 we will discuss in detail. Arre Baba, everything we cannot bring like this, no. Everything should be supported with one journal entry. So what is the underlying journal entry behind it? So Ind AS 2, perfect. I'll tell you, I'll make you very perfect about this inventory valuation, what is this COGS, how it moves and all. So this should have been my journal entry. So that journal entry I will reduce by 15,000 rupees, because I have to state at cost. With this entry, this will become 20,000. So rather than passing two different entries, Since Cox is debited with 15, Cox is crediting 13, institute has passed one consolidated entry. Clear? Perfect. Yes. Question number 6. You pass the entry, no? In the above illustration, assume that the parent makes the sale and the parent owns 60% of the subsidiary. Parent sell the inventory to the subsidiary for 35 and makes profit of 15,000 rupees. On the sale of inventory, subsidiary is and the inventory is lying in the balance sheet of the subsidiary. Now examine the treatment. Okay, right? This is downstream transaction. Is there any URP? How much? Full 100% URP. If they tell you out of this 60% is sold, so 40% is your 40% of 15,000 is your URP. If they tell you that this you see parent sold to subsidiary, what if 60% of it subsidiary sold to third party? 40% of 15,000 is URP. Now whom we are going to give this? This is allocated only to parent because it is a downstream transaction. So my accounting entry will be consolidated revenue same, because revenue is same, no baba. Whether it is there in the subsidiary sells to you or you sell to subsidiary, in somebody's P&L sales is there, that it gets reversed. In somebody's system, somebody's P&L Cox is there, that also will get reversed. And closing stock. But this is allocated only to parent, not to the subsidiary, not to the NCI, sorry. You just reduction and NCA balance you reduce. Yeah, it's not an accounting entry, it happens, it is an adjustment. In the format it will happen. Why we are reducing? Because your closing stock is overstated, no? Overstated portion. Because you cannot, at a CFS level, you cannot carry your inventory at more than cost or NRV, whichever is low. Because same policy applies at a CFS level also. Yes, next question. A limited parent sold goods costing 200 to 80% subsidiary and at 240. 50% are lying in the stock. B measured the inventory at cost of 240 into 50, that is 120 lakhs. A sold 200 worth 240. What is B's cost? 240 is B's cost in its standalone. And since at the end of the year 50% is unsold, they valued inventory at 120. What is my necessary adjustment, assuming tax rate to be 30%? Okay, right? 1. This is upstream or downstream? No, we have to see, show the necessary adjustment. They didn't ask me the journal entry, we have to do the adjustment, we have to explain. This is downstream transaction. Is there any URP? For this you have to see, is that stock is still available or third party? Stock is still available. How much? 100%? No. So if this question comes in the examination, probably 60-40 may come. Everywhere they will give you 50-50 only, it doesn't make any difference. So what is my URP? How much is my unrealized profit? 40 is unrealized. 20, which is 40. 240 minus 200, this is my total unrealized profit, into 50%. Because 50% is unsold. This is allocated only to parent. So in my format, no, only in one line, first parent portion, CONPL only it will come. NCI deduction will not happen for this. In 20, there is no 2 leg, there is only 1 leg. Yeah, I'll show you at a CFS level how this will happen. Done? Am I done? Or anything else is there? One amount they said, assume tax rate to be 30%. So what is going to happen because of this adjustment? Do we have a deferred tax asset or deferred tax liability? Okay, to calculate deferred tax asset or liability, first thing I need only two pieces of information. What is my book value? Book value? Where I am talking? At CFS level. After you passed this entry, you will reduce, no? After you pass this entry, will you reduce your, first of all, deferred tax will come for P&L items or balance sheet items? Is there any item in the balance sheet? Yes, stock is there in the balance sheet. After you passed elimination entry, what is the book value of the stock in the balance sheet? 100. What is the tax base of the inventory? Base 120, no? Because when the parent sold to subsidiary, there was one check post. In that check post, one income tax officer was waiting there, and he noted one number, no, which is that the transfer price. So in the SFS, it is stated at 120, right? So income tax department will say this is your book value. I will recognize not your unrealized elimination and all, I don't understand. So this, my book value is 100 at CFS and tax base is 120 as per income tax. You remember in Ind AS 612, we passed one entry, one question 48,000, 60,000. There was one CFS related one, deferred tax calculation, same story. On this deferred tax, asset will come or liability is going to come? It's an asset or liability? Asset. When the book value of the asset is less than the tax base, we have got deferred tax asset. Yeah, 120 is lying in SFS because when the income tax is filed, the return is filed by the subsidiary, which value they will show? Are they interested in the CFS value? Or are you going to file one more income tax return only for CFS? No, you will always file the income tax return keeping SFS as a base. In the SFS of the subsidiary, when the income tax return is filed, the value of the closing stock is 120 there. So that's the tax base. Where 50% is owned. That's what. No, if I already sold, then there's a question of deferred tax. When no, they said no. Parent sold to SFS and they said 50% is remaining no here. No, that cannot happen. No, it is only if this 100% sold to third party, then this particular inventory is not there in the subsidiary's balance sheet also. Parent has sold to subsidiary. In parent's book, no inventory now. Zero. Subsidiary's book inventory is there or not? It is there. Do you have 100% inventory? No, you have got only 50% inventory. That's why you have to take only 50% value. Imagine if 100% was sold by subsidiary to third party. Then there is no URP only, no. And no URP also, no deferred tax also. It's a fresh thing. That's what I told. No, 103 and URP doesn't come into picture. 103 is you take over the asset at a fair value. URP will have a subsequent. After you do 103, subsequently if you do intercompany transaction, then URP is going to come into picture. Don't mix both. That's a fair valuation only on acquisition date. This is URP is on subsequent transactions. Yes, Prithvi? Understood, no? Yeah. I wish again, please ask me at this point of time only. You discuss, let us discuss more. Because more of the questions I will give you, only do it. Once I show you how to do it. But at this point of time, if you discuss with me, you come with so many possible questions and all. Yeah, it's good for you. Me also. Okay. So the last point is deferred tax asset of 6 lakh rupees will be recognized on this unrealized profit, because this unrealized profit is going to create a difference between the book value of the inventory in the CFS versus tax base of the inventory of this particular inventory. Clear? Next, RAM parent company purchased goods costing 100 from its subsidiary at 120, and now the 50% goods are lying in the godown. Now in your balance sheet you recognize the inventory at 60 lakhs. What is your adjustment? Okay, so the first thing you will say, this is upstream. Second, URP is equal to, how much is the unrealized profits? 10. See, costing 100 you sold for 120. 20 is the total profits at a CFS level. Actually, this chapter is much easier when it comes to your URP. There in Ind AS 28, no, I have to think my parents' share and all. Here, no headache only. You just see, there I have to see gross profit percentage. Is it on cost or is it on this thing? Here, there is no headache, no. Here, just to see total profits. Okay, how much is the total profit? 20. How much is unsold? 50% is unsold. Do you have a deferred tax asset or liability? Do you have a deferred tax asset or liability? See, the previous thing was a upstream transaction. Sorry. Previous was a downstream transaction. We ended up with a deferred tax asset. This time it is a upstream transaction. Do you have a deferred tax asset or liability? Asset only, no. Does it make any difference? Because the inventory is there in consolidated balance sheet. What's the book value of it? What's the book value? 50. After 60 was there, because you showed 60, URP you reduced 10. What's the tax base? 60. Deferred tax asset. That's it, simple. So it doesn't matter whether parent sells to subsidiary or subsidiary sells to parent subsequent to business combination. For unrealized profit portion, which comes only if the inventory remains unsold, to that extent only you will have a deferred tax asset. Because at a CFS level, the inventory will be shown at cost, and in one of the SFS, it is shown with the profit, and this is going to create the difference. Yeah, these standalone questions just for our understanding as of now, because these adjustments may come there later. This is only for our understanding purpose, so you need not write language and all, you need not bother. Have you understood the concept here? Upstream means why we should deduct from both, downstream means why we should give to only one, deferred tax impact is there, if by chance they give 30%, what should I do? A Limited, which is involved in the business of selling capital equipment. See, understand, your business itself is selling capital equipment. A parent company sold a capital equipment costing 100 lakhs to its 80% subsidiary at 120 lakhs. The capital equipment is recorded as PPE by B. See, problem is one entity will record it as a sales because your business is selling equipment, and the subsidiary will record it as a PPE. At the end of the year, what it is? It's PPE. Because it doesn't matter whether you have given to subsidiary or whether you are using yourself. So Ind AS 2 says that the day you start using your own item which you are selling, you have to convert from Ind AS 2 to PPE. The useful life of the PPE on the date of transfer was 10 years. Show the necessary adjustment in the CFS. Okay, so write A Limited reduce value of PPE. How much is recorded in the PPE in the total CFS level now? 120 by rupees 20 lakhs. Why? Because the 20 lakhs is URP. 20 lakhs is unrealized. This would increase expense and reduce profit by rupees 20 lakhs. Depreciation shall be reduced by how much? Rupees 2. 20 by 10 years. Have you understood? See, first of all, your PP at the CFS level is overstated. You had one inventory with you. Inventory was valued at what price? Cost or NRV, whichever is low, cost. You sold this at NRV to a subsidiary. And subsidiary recorded at a PP 120 and started to charge depreciation on what? On 120, 2 rupees extra. Now I consolidated. When I consolidate, it sounds like my own inventory, which was costing 100, I converted into PP of 120. How it's possible? So should I not reduce the profit and reduce the value of inventory also? Value of the PP also. So what accounting entry I should pass? Exactly. So this is for our understanding. If you want, you can pass. Same entry, instead of inventory here, I will reduce PP. In this, is there any distribution? No. This will go to whom? Parent only. Why? Because this is the downstream. This is the downstream. Already it's sitting in the parent's P&L. No. It's not sitting with the subsidiary P&L. If it was from subsidiary had sold this PP to parent, this 20 would have been distributed to 2 people. Why? Because when you do it line by line consolidation, one element of profit is sitting, it is sitting in totality with me. So if it is an upstream, unrealized profit on my in PP also, I should have distributed for both the people, NCA also. Because they have taken their share of profits there at the end of the year, which is unrealized, which is with me only. Now, depreciation, okay, because of this, how much it came? See, totally at CFS level, what is the value of the depreciation at the end of the year? At the SFS of subsidiary, what is the value of the asset at the end of the year? 120. Did you charge minus depreciation 12? So it became 108. What should have been at the CFS level? 90. Okay. So now you will pass that differential entry because one more depreciation 10 would have come there. So the 2 extra depreciation you will reverse. You will pass PP account debit to depreciation. Okay. Because of this, 1 minute. Yeah, I'll show you. Yeah, PP should be debited, no, because you at a CFS level, depreciation is overstated, no. In subsidiary P&L, how much is the depreciation? 12. 12 is the subsidiary depreciation, no. In CFS, how much it should have come? 10. That is why you charge 2 rupees extra depreciation in the subsidiary. When it got consolidated, 12 rupees depreciation came and sat with your depreciation. So you reverse that 2 rupees extra depreciation. Yeah, I'll show you. Understood, no? This part is clear. So we have seen the unrealized profits on inventory, then unrealized profits on PP. See, this is the journal entry given by ICI. They said consolidated revenue to cost to PP to depreciation. See, one single entry they gave. Now I will show you the effect, not only for our understanding. Purchase price was 120, correct? Now depreciation in the books of subsidiary was 112. So they showed a balance of 108. Then I reversed the unrealized profit. 108 minus 20, how much it comes to? 88. Then I reverse that excess depreciation, add. It became 90. Imagine if I would not have given, instead of giving to subsidiary, I only converted this into my PP. What value I would have converted? 100. How much depreciation I would have charged? 10. What would have been today's value? 90. So 90. That means if I do this type of activity with an unrealized profit, these are all additional interest should come now. Because ultimately I have to show as if this inventory was with me only, if this PP was with me only, what would have been its value at the end of the year? That I should represent. This will continue. On this deferred taxes will come now. Deferred tax, see, in SF, okay, let us go into the SFS level, CFS level. In CFS level, what is your closing balance of the PP? 90, no? After all this adjustment, 90. In SFS, what is the closing balance of the inventory? 108. Okay. On this difference, deferred tax asset is going to come in the CFS. We have to, and more than that, it is not 108. It is, because 108, when I say it is SLM basis, we have to go and check what the income tax department is telling there, whether 6 months accelerated depreciation they have given 182 days and less than, God knows, no? We have to check those three conditions. Reversals, that's why we have to keep a track of this. So many things are there. In consolidation, see, again at a consolidation level, in reality, what you are using it? PP. So PP. It doesn't matter whether you are using it as a PP or a subsidiary is using it as a PP. In reality, what it is? Inventory, no? So if it is inventory for you, it is everywhere. At a CFS level, on that day, last day, what exactly you are doing with that, that should be the status. Now deferred taxes are going to come, reversals has to be tracked, so many things are there. One for this and then for the reversals. And depreciation also is going to come, because one is for URP, another is for the depreciation difference. Don't worry, in final examination they will not trouble you like this. Either they will ask you one standalone question like this, but none of the questions you have got this much, but you have understood the depth. Have understood the depth of, that's what I am telling. No, it's a specialization, Baba. After you become CA, you can be full time into this deferred tax consolidation audit only. So many things are going to come there. So many adjustments will be there. And without a system, okay, there are some specialized system called Hyperion. Hyperion's job is to consolidate only. And without that, no, accountant, you are going to leave the job actually. Because tracking, and imagine no one company is like Adani, Reliance having 250, 300 subsidiaries, having sub-subsidiaries, which they restricted, more than 2 layers you don't have. Imagine how to consolidate, and you have to give that consolidated value is true and fair, and all these adjustments has to be adjusted, and that's our profession. No, but it gives a picture now. See, what we are talking is a very small thing, okay, here, but in reality it can be a very big amount, no? It can be, God knows what they are doing at a consolidation level, from which subsidiary they are transferring where, God knows what type of structure they have created, how they are routing it. This is what Enron did, and from then we have to learn. Our accounting standards got strengthened now. The simple thing is, you can't escape. That's why we as auditors, we have to be very shrewd, and we need to have that understanding actually. Otherwise what happens, this is going to skip from us. It might have skipped from that. See, and at the same time, other side of the table, who is sitting? Another chartered accountant only, no? We are hired in the industry to do this job only. So I need to have that understanding, like whatever you are asking me now. So deferred tax, obviously, Baba, because if you don't calculate deferred tax, somebody will come and catch you there. If amount is material, then gone. Black remark. Anyhow, enjoying, no? Yes. Take out question number 10. Important question. This question may come for your exam. Airtel Telecommunication owns 100% of the share capital of Airtel Infrastructure. Okay, good. On 1st of April 2011, Airtel Telecommunication acquired a building from Infrastructure. Upstream or downstream? Upstream. Upstream transaction. Okay. Now, building is with whom now? Parent. For 11 lakhs. And the group plans to use it as a new headquarter office. Okay, now you took over this asset at 11 lakhs from your subsidiary. So in parent's SFS, it is shown at 11 lakhs. Airtel Infrastructure Private Limited, who is a subsidiary, purchased this building just 1 year back at 10 lakh 25. See how beautiful question they will frame. They can make your life difficult, giving some other dates there. And at that time, the building was assessed to have 21 years useful life. Oh, on top of it, very beautiful. That means when you acquired, you have got only 20 years useful life. And the value is 10 lakh 25, perfectly suited for 21 years life. Residual value is 5 lakhs. Now, how much depreciation, what would have been book value on 1st April 2011 when the subsidiary sold to parent? See, when you acquired, it was 10 lakh 25,000, correct? Minus 5 lakh is the residual value, divided by 21. 25,000 rupees is the depreciation every year. So exactly it came 10 lakhs. So on the date of sale, in my SFS, it was 10 lakh. It was given to parent at 11 lakhs. So my URP is 1 lakh in an upstream transaction. On first of, then how much is the going forward depreciation you will charge? On 11 lakh divided by 20 years. 11 lakh minus 5 lakh scrap value divided by 20. You will start charging 30,000 rupees. That means that 1 lakh rupees also get depreciated for next 20 years. The carrying amount of the building was 10 lakh in the individual records. Okay, we already calculated it. The estimated remaining life is 20 years only. However, the residual value is now 3 lakh 50. So it is not 30,000 depreciation. 11 lakh minus 3 lakh 50, 7 lakh 50 divided by 20 years. So you will be charging 37,500 depreciation in parent SFS. Now pass the entries in the individual and the consolidated situations. Maybe, yeah, it's a subject matter of an assumption, but they have not considered it as an inventory. They treated it as a building only. Yeah, very good, nice. Even I have never observed it. It's an see, and one more thing. Yeah, there also I would like to tell you. They said Airtel Infrastructure. Which infrastructure? Building infrastructure or their telecommunication infrastructure? If it was a Airtel Real Estate Limited, then we could have said. But yeah, observation is nice. But what we may have to assume that which infrastructure they are talking is not a building infrastructure. They are telecommunication lines that you have that wires and all. No, that infrastructure they must be talking. Yes, so we'll pass the journal entries in the books of subsidiary. Solution: journal entry in Airtel Infra. First is 1/4/2010. What entry I'll pass? Building to cash. How much? 10,25,000. Then 31/3/2011 depreciation to building 0.25. Then on 1/4/2011, what entry? Bank account debit. Can I say bank account debit? 11. Bank or whatever, Airtel Infrastructure. To building at what value? 10 book value. To P&L. So I will transfer it to my P&L 1 lakh. This is what a SFS of a parent, a subsidiary would have looked like. Done. After this, they will not pass any entries on 31st March 2012. Why? Assets itself they don't have, then where is the SFS? Done. Now, once they transfer, their accounting entries are done. Now, let us pass the journal entries in the books of the parent. When the parent will pass the entry? 1st April 2011. What entry? Purchase account, building account debit to cash. 11. Then depreciation when 31st March 2012. Depreciation how much? 37,500. We discussed it. 11 lakh minus 3 lakh 50 divided by 20 years gives you 37,500. They asked me pass the journal entries in the books of standalone books of the subsidiary and the parent, and also consolidation adjustment entries. In consolidation, parents, what is the book value of the building? 11 lakh minus 37,500. 37,500. This minus this is the book value. So that will go automatically. But is that correct value? No. If this building was with me only, it would have been shown at some value, right? So write one note, working note number 1, excess depreciation. Excess depreciation. How much would have been depreciation? What is my actual depreciation? 37,500 less. What is depreciation on original value? Catch. Is it 25? If this transfer would not have happened, how much my subsidiary would have charged depreciation? Come on, we have done Ind AS 16. Residual, change in estimate, no. We have done change in the estimates, have we not done that? So you will say that 10 lakh minus 3 lakh 50 divided by 20 years. So it is 32,500. Followed? No, this is coming from Ind AS 16 now. So 5,000 depreciation, I started to charge high at a CFS level. Done. Now, can you suggest what accounting entries? See, I will take balance sheet assets straight away as it is. How much? 11 lakh minus 37,500 is the book value. 10 lakh 62,500 I would have taken straight away. P&L depreciation 37,500 straight away I would have taken, which includes 5,000 extra. Now, at a CFS level, should I not pass any entries? Yes. What entry I am going to pass at a CFS level? CFS, right, CFS entry. How many entries are going to come, or what entries are there? Sorry? Reduction of depreciation. Another? That's what, no, I have to pass. What entry I will pass for URP? This one unrealized profit, no. Should I pass any accounting entry for that? What entry I should pass? Profit to building. Should I distribute or should I take to only parent? Okay, it's 100%. If it was not 100%, distribute. Why? Because it is an upstream transaction. So my accounting entry will be unrealized profit on sale of PPE, means consolidated P&L account debit to building. So since you have got an 100% subsidiary, your distribution concept doesn't come. Otherwise, this should have distributed among the parent and the subsidiary. You would have reduced from both the people. Clear, no? Now there is one more item. What is that? Excess depreciation. How much? 5,000. What entry will pass? Building to depreciation, which is consolidated P&L. See here, CPL is going to come. Con PL, consolidated PL. This is the excess depreciation reversal. In the exam, they may ask you to prepare a statement also, or even though they don't ask, please write, prepare a statement. Again, up to now, whatever whatever questions we have done now, the only probable question is this. So please mark this question. Other questions are okay, more into an academic thing, and even though it comes not more than 3 to 4 marks, this question may come for 6 marks. Now let us prepare a statement. Okay, so we will have 3 headings, 3 columns. First is CFS, Telecom, Infra. On 31st March 2011, how much is your CFS showing balance? Okay, how much was there in the infra? 10. 31st March 2011, because this transaction happened on 1st April. How much is CFS level? 10 only. On 31st March 2011, because this transaction happened on 1st of April. On 31st, see, if you talk about 1st April 2010, it was 10.25, then depreciation not required. Now, 1st April, it became 11 here, 10 got minused. Agreed? Did you prepare CFS? No. Then you charge depreciation. How much depreciation? 37.5 or 0.375. At CFS level, 0.325, because you reverse that excess depreciation. At the end of 31st March 2012, the balance is 9,67,500 in the CFS, 10,62,500 in the SFS. Imagine if this asset would not have been transferred, what would have been its balance? Same, 9,67,500, but sitting in the infra balance. So for a consolidation level, 2 entries are going to come, and those entries are going to reduce this balance to this. Without these 2 entries, it is not going to reduce. Clear? RTP question. An entity owns all the share capital of entity B. On 1st of April 2012, entity A acquired a building from B for 600 lakhs. And the group planned to use it as an head officer. I think the similar question. And B has purchased the building from a third party for 525 lakhs. Building was assessed for 21 years. Carrying amount of the building is 500. Entity B's financial statement, estimated remaining life is 20 years. Residual value is nil. The method of depreciation is SLM. Pass the entries to record the transaction in the group's general ledger. Yes, students. So this is the last question. Please do it. Please pause the video, do the journal entries, we'll compare. Yes, sir. So we'll compare the answers. So the first computation of the depreciation adjustment at a CFS level, the adjustment of depreciation comes to 5. Did you get this excess depreciation? Okay, so we understand that 500 and 525 by 21 years, 600 by 20 years. So this is SFS of both the parties. Depreciation should have been so and so. Now in the books of B, building to bank 525, depreciation to building 25, and then you sell the building and recognize the profit of 100. Now in the books of A, building to bank you get 600, you start charging depreciation also, yes, done. At a CFS level, which they didn't show separately, profit on sale of building you are going to eliminate with the building 100, and depreciation building to depreciation, excess depreciation you are going to reduce. No mistakes, no? Yes, so we have, see in my format, the biggest problem is related to this unrealized profit, fair value adjustment and all. Then we will look into the NCI calculations, closing balance. Very simple actually. Again, I should go fast here. After this, we will start with the consolidation problem, because with this I can reasonably say that whatever adjustments we have discussed it, some fair value adjustment with the numbers I will show you that closing stock related. Take out question number 12. A XYZ purchased 80% shares of ABC on 1st of April for 1,40,000. The issued capital was 1 lakh and the balance in the P&L was 60,000 on that day, 1st April. So what is this 1 lakh and P&L balance? This is your net asset, which is nothing but equity plus reserve. Book value of the net asset is 1 lakh plus 60. And on that day, you acquired the subsidiary for 1,40,000. Now for the year ended 31st March 2012, ABC earned a profit of 20, because of which your net asset is going to increase, which is represented by increase in the retained earnings. So your retained earning has become 60 plus 80, 20. But here you need to give 80 for you, 20 for NCI. And they declared and paid a dividend of 30,000 rupees. Again, out of the 80% for you, 20% for NCI. Assume the fair value of the NCI interest is same as the fair value on per share basis of the purchase interest. Generally, it cannot be. What they said, what is the fair value of the NCI? It is same as the fair value of the purchase interest. And they said this assumption is only for this illustration purpose. In practical scenario, fair value of NCI will be lower than the fair value of the controlling interest because it includes control premium. What did you understood with this sentence? With this language, what did you understood? Okay, I'll complete this also. All net assets are identified and there are no non-identifiable assets. That means whatever assets are there, like brand, deferred tax, all those things are not there. And the fair value of the identifiable assets is 150. Now, what is the meaning of this? See, you acquired an entity. What is the purchase consideration you paid? 1,40,000. Did you pay for 100%? No. Was there a step acquisition? Was there step acquisition? No. Was there an NCI? Yes. At what value you are going to value NCI, measure NCI? Then you have got two methods. Will you follow fair value method or proportionate net asset method? Who told? Arey Baba, they said very clearly, no, assume the fair value of the NCI. They want you to value NCI based on the fair valuation. Have they given you the fair valuation? Because in every question they used to give you the fair valuation. But they said, look, what is the fair value of NCI? It is the fair value on per share basis. That means you acquired 80% by paying 1,40,000. What is the value of the business as a whole? 1,40,000 divided by 80%. How much? 1,75,000 into 20% is the value of NCI, because you have to measure the NCI using fair value method. They didn't tell you straight away. Then they gave one note here. Look, this method of valuing the NCI, what you did, no, it is not correct. No, not a partial goodwill method. What they are trying to tell, see, when you paid 1,40,000, this 1,40,000 includes control premium. How can you value the NCI based on what you pay? Because to pay 80%, have you paid something extra? Because you wanted to get a control. Now NCI, you cannot value at that price. But for illustration purpose, you consider it for time being. That's why in all questions except this, every single question, whenever they said value NCI based on fair value method or full goodwill method, they told you the amount of NCI. No, they are not contradictory. It is your interpretation. You are interpreting it like this. I am telling you the right interpretation. Right interpretation, what they are trying to tell you, you have to value using fair value method. But in every single question, they would have told you fair value. You look, where is fair value? Where is fair value? There is no fair value. But they told you to vary fair value. They told the methodology. How? You take 1.4 divided by 80%, multiply this by 20%. And at the same time, they gave note, look, this what method you are doing, no, of NCI evaluation, this is wrong. Why? Because when you paid 1.4 for 80%, it includes control premium also. You can't take that as a value to value the NCI, because NCI doesn't include your control premium, no. But since no other information is available in the question, use this method to value your NCI. This is the interpretation of this particular sentence. If you misinterpret, I don't know, you will end up doing something different only. Sorry? What you do? Purchase consideration, add NCI minus FVNA you do, no? FVNA value is this. Alternatively, you say, sir, I will take into 20% of this. This is when it is a partial goodwill method. This question tells you what? Which method to follow? Full goodwill method, no. No. Again, you have not understood. They said you to follow full goodwill method. But for full goodwill method, you need the fair value of NCI. Every single question till now they gave you. This question they didn't give you. Ulta, they gave one methodology. And at the end they said that this assumption or a methodology what we are suggesting you to in this illustration number 10, it is only for this purpose. In reality, practically, people don't calculate NCI value like this. They wanted to add some practical insight into it. I don't know. We have that you can take, because when you pay, see, okay, I'll tell you how it is possible. In AFM, have you solved the problems on mergers and acquisition? In mergers and acquisition, there is one problem comes. What is the minimum amount payable to the shareholders, the selling target company? You say the market price. Just because you give market price, will they give you a control? No, they ask market price plus control premium. Only if you want to transfer the control. But if you don't want to transfer the control, say 40% stake you want to give, you will give it at market price only. So NCI can be valued at a market price. But if you want control, then it is market price plus control premium. But you can't take this into 80% into 20% NCI valuation. Understood this sentence? You could have taken share price into fair value. Reasonably, you could have assumed that. Price of the acquiry. Which is not having control premium. No? Did they tell you how did they arrive 1,40,000? How? Yeah, purchase. This is the purchase price. But did they say this is the market price? Exactly. Now you understood. This 1,40,000 has got two components. One is something like a market price plus goodwill. Clear? So no misinterpretation. Huh? So now show an entry how the dividend should be recorded in the books of XYZ whenever it is received after approval in the ensuing in the next AGM. XY is the one who has to prepare CFS now. Now you are going to get the dividend. What accounting entry you need to pass? Then what is the amount of the NCI on 1st of April 2011 using fair value method? Very specifically told. Forget this. Here openly told. Follow fair value method. So you cannot take 50% of 1,50,000, 20% of 1,50,000. On 31st March 2012 at the end of the year, pass the journal entry on the acquisition date. Okay, right? Dividend entry. They asked me the dividend entry. What is my dividend entry? Bank account debit to dividend income and SFS level. Because it is SFS level. Then they asked me what is the amount of NCI interest. For this I need a business value. And pass journal entry. Okay, so working note number 1. Okay, this is done. First they asked me the dividend entry, we pass the dividend entry. Okay, working note number 1. Fair value per share basis. You have to calculate the fair value per share basis. Fair value of business on 1/4/2011 is equal to 1,40,000 is the consideration paid divided by 0.80. It is 1,75,000. Working note to goodwill. Goodwill. We got the business value now. This business value is required to value the NCI. Then they passed one accounting entry also in the CFS. They asked, no? Also pass an entry on the acquisition date. To pass the entry on the acquisition date, don't I need the goodwill? So goodwill, start with the purchase consideration. How much? 1,40,000. Add NCI. How much? 1,75,000 into 20%, which is 35,000, minus see, first they asked me one journal entry for dividend, I passed it. Then they asked me pass the opening entry, minus FVNA. How much? 150, which they gave me. So I end up getting goodwill of 25,000. Clear? This is when 1/4/2011, beginning, initial acquisition date. Then my journal entry is going to come. See, these are all the working notes we have done to pass this journal entry, because to pass this journal entry, I needed those two working notes. Without that, how do I get the value of the NCI? How do I get the value of the goodwill? They said me pass one journal entry on the acquisition date. So important question, they may ask you in the exam. Is the jumbled English language? Clear, no, Vidya? Clear, no? And what else did they ask? Is there anything else they asked? What? NCA balance at the end of the year. See, they asked you dividend entry, you passed. They asked you acquisition entry, you passed. And then they asked, what is my NCA balance at the end of the year? For this, you need the NCA balance at the beginning. Is it available? Yeah. So prepare one statement, NCA balance at the end, closing balance of NCA, for which I start with the opening balance. During the year, did my subsidiary made any profits? Definitely. Have they told you? Wait, 20, no. They made a 20. So you have to give a share of profit. So you give the share of profit, 4,000. Is there any dividend given? But which year? During the year 11-12, was there any dividend? For the year ended 31st March 2012, ABC earned a profit of 20. And later on, that means by 31st December, did you declare any dividend? You passed one journal entry for dividend, no? First, on which date? Huh? 2002-3, right? Or you didn't write the date? Write the date, 2002-3. Now by 31st March 2002, did you declare any dividend? No, this year no. So nothing, finish. My closing balance of NCA is 39,000. If at all this year, 2011-12, if any dividend was paid, you would have deducted it from the NCA. You paid 30,000, but when next year? So next, if I ask you, what is my 31st March 2003 balance? Then opening balance is 39,000. Add 2012-13 share of profit minus, in that 30,000, 20% share is going here. This is when 31st March 2013. But did they ask you 31st March 2013 balance or 12 balance? 12 balance. So 39,000 is my 31st March 2012 balance. Yes, Prithvi, clear? Okay, that's why you have to be very clear about the dates there. Now, when this acquisition happened? 1/4/2011. Sorry, 80%. Then dividend, because we received it. This is after 31st March 2012. No, that's why I wrote the year 2000, and they didn't tell me the date. They say as and when it is approved. That's why I wrote the date 2012-13. I don't know. 12. That's why there is a confusion. This question they may ask you. It will not possible, no, because your AGM has to approve. Board of that. That's why dividend is not. That's why you have to complete Ind AS 10. Ind AS 10 says that board of directors dividend is not a subsequent event. So you can just give one if board of directors propose it in your note, because see, by the time AGM happens, board of directors have to sign, and the moment board of directors have to sign the financial statement, your subsequent event finishes. That's why if the directors propose, you have to give in the notes to accounts. Not, you will never make any entries. Entry will happen only next year AGM. See, when you have that understanding, this problem looks simple. Otherwise, if you are confused with when dividend happen, when I have to make a provision, this little problem looks confusing only. And see how beautifully they have asked dividend entry only in the books of, and without telling dates also there. Are you very clear about all the journal entries here? If I would have asked next year, then I would have deducted NCI dividend next year. From the facts given above, calculate the amount of NCI as on 1st April using proportionate share method. Okay, just tell me the balance, okay? Entry is not required. Entry, so we know now. What is my balance of goodwill? Yeah? I want everyone. 20. How much you said? If you follow proportionate asset method, what is my balance of the goodwill? Sorry, yeah, 20. What happened, Ministry? 20, no. 1,40,000 is the purchase consideration. I asked goodwill, no. And 1,50,000 is 20% share is 30 minus 1,20,000 is the goodwill. And they asked pass the journal entry. Okay, if you want, you can leave some space. Easy, right? So you'll not spend much time here. We'll proceed further. So this is my journal entry where identifiable assets, goodwill, bank to NCI. Because for this working note 1 is not required, because fair value calculation not required here. I can proceed further. Clear, no, everyone? Next, closing balance of NCI will remain the same here. No, it will not remain the same because opening balance is going to change because this is proportionate net asset method, PNA method. So plus 4,000, 34,000. Now, facts are same except identifiable assets is 1,60,000. What is my NCI using fair value method? Amount, can you tell me the amount? Please do it. If you make a mistake, you have to do it. So you can write goodwill is equal to purchase consideration 1,40,000. Why you have to write all the story? Minus 1,75,000 into 20% minus 1,60,000. So your goodwill comes to 15,000. What is my NCI balance? 35 plus 4,000, 39,000. Yeah, if you can make a note or you can leave some space. Sorry. NCI, I'll pass this entry at the beginning of the year. At the end of the year, 35 plus 4, there is no dividend, 39. What if the same thing under proportionate net asset method? 12,000 is my goodwill. First you said about the 12,000 from proportion. Be careful. They said fair value method. So in this case, I would have taken 1,60,000 is 20%. And NCA balance 36,000. Very simple. See, since we have done Ind AS 28, this should not look problematic. Yes, journal entry is this, and your closing balance is 36,000. Okay, next question is important. This question is, I think, whether it has come for exam. It has come, no? Yeah, nice question. From the following data, determine in each case the NCI on the date of acquisition. Easy. How? Using proportionate. See, at the proportionate share method. So proportionate net asset. You have to find out the NCI. Goodwill or bargain gain, very easy. You have got a purchase consideration, NCI is there, minus balancing NFA, you get the goodwill. Amount of holding company's profit in the consolidated balance sheet, assuming your own retained earnings is 20,000. That means they are, see, these two things are coming from 103. This is coming from 110. At the end of the year, what is the consolidated profit of the parent? If parent's standalone profit is 2 lakh. In all this, see, case 1, case 2 means it is not case. It is subsidiary 1, subsidiary 2, subsidiary 3. We have got 4 subsidiaries. Because don't add 2 lakh, 2 lakh, 2 lakh, 2 lakh. It's not 4. That's the confusion. That's why this question came in the exam. Case they simply gave. It is not case. It is one case with 4 subsidiaries. Don't every time add 2 lakh, 2 lakh, 2 lakh. No. All the profits of the subsidiary you have to take irrespective your share, plus 2 lakh is your consolidated profits. Why they mean to, you will get confused, no? If they give you proper, then you will not get confused. At a time for subsidiary, exactly. You will again one more question, sir, how do you know? I know because in the solution they have done it like that. Okay, so understand how it interpreted what they have done. See, now you have got 4 subsidiaries called ABCD. See, if it is the case 4, then why should they give me different subsidiaries name? Tell me. If it was 4 different cases, why they should give different subsidiary name? So in first subsidiary I hold 90%, 85, 80, 100. What is my purchase consideration cost? This. On the date of acquisition, what is my net asset? Share capital plus retained earning? This. At the end of the year, what is my net asset? This. What is the difference between this net asset and this asset? Profit, P&L. So I have to take my share of profit at the end of the year, 90%, 10%. The difference between these two, at the end of the year, I have to distribute. 90% I will take, 10% I will give to NCI. And NCI, they asked me only on the date of acquisition and at the date of consolidation. Oh, 103 and 110. So 103 will come very easily. We have done purchase consideration is there, 10% share is there, proportionate net asset method we have to calculate. This is my net asset. We'll do it, don't worry, we'll do it. It looks little complicated, but it's a very simple thing. At the end of the year, I have to start with the opening NCI, and whatever difference between these two, that 10% profit I have to distribute to them. Very simple. The company adopted an accounting policy to measure the NCI. Not required because already they have told me here. They said that I am going to follow the proportionate net asset method. Okay, right? Solution. First, NCI calculation. So you have got subsidiary A, B, C, D. And what is your NCI percentage? 10, 15, 20, dash. Now, they have told you follow which method? Proportionate net asset. So, what is your net assets on 1/4/2011? 1,50,000 equity plus reserve. 1,30,000. 70,000, 90,000. And what is your NCI? Opening NCI? 15,000, 19,500, 14,000 dash. Easy, no? Done. So in the first question, there are two sub questions. What is your NCI on the date of acquisition? It is net assets proportionate value. Then they asked you what is your NCI at the end of the year. There are two ways. One, find the difference between net asset at the beginning, net asset at the end. Take this profit into 10%, add it to the opening balance of NCI. Alternatively, net asset is there at the end, no? Take 10% of it, finish. So you will write net asset on 31st March 12, which they have already given 1,70,000, 1,20,000. Understood the logic, no? And I didn't remember in Ind AS 28, I told any point of time you take the net assets and multiply 20%. If you have followed proportional net asset, its balance is always same rather than doing this way. And closing NCI will be 10% of this 17,000, 18,000, 14,000. Alternatively, you have to find the difference between these two, multiply 10%, add it to 15,000, you would have got the same value. See, this is a very small, simple question, but this question also came in examination. How many marks? 8 marks. Oh, then, because it looks a bit confusing, Baba. And see, consolidation means students first of all think, oh, consolidation. So, generally, they don't touch, they skip this chapter. That's why they know. And from there, they will give you a question like this. Why we should believe this? That's why all probable question, what I tell you, no? Practice it thoroughly. In a new syllabus also it may repeat. Okay. Now let me go to the goodwill calculations. See, first question we finished. What did they ask me? Second, goodwill calculation. See, in our goodwill calculation, we follow this method, no? Rather than columnar. I will say A, B, C, D, because we are used to this method. NC also we could have done that, where I start with the purchase consideration. How much? 1,40,000, 1,04,000, my cost. Cost they have given, no? 56 and 1 lakh. Plus NCI, which is already there in working note 1 or step 1. In the previous step we have done, no? Opening, goodwill when you are calculating, on that day only, no? Generally, we used to do here only, in bracket. But since we are 4 subsidiaries, bracket is difficult job for me. Already we have done that. 14,000, and in the D there is no subsidiary. Minus FVNA, fair value of net assets, which they have already given me. 1,50,000, 130,000, 70,000, 90,000. Yes, you got the goodwill. See, you got a goodwill for A and D. But for your subsidiary B, you will get 6,500. Did they ask you goodwill at the end of the year? Chalo, even though they ask, what you will say? Same thing. Because only two things are going to change this. One, measurement period adjustment. Is there, have they told you anything? One customer brand was there, it was missing. No. Is there any impairment? No. Because only these two things are going to change these numbers. Otherwise, at the end of the year also, it's the same. That's why I always tell in consolidation, the very first step is to go, whether 4 years back or 2 years back, prepare this goodwill calculation. Because you want two things there from that, opening NCI and opening goodwill. What is the third thing they asked? Give me consolidated profit. Third, calculation of consolidated P&L. How much is parent P&L? Let me go to my format. In my format, always first I will take parent's financials. 2 lakh. Third thing, they asked me calculation of consolidated profit. The third question. So for me, first thing I'll go to how much parent earned. Parents profit. How much is my parents profit? 2 lakhs. Plus, did subsidiary earn any profit post acquisition? Yes. So A's share, how much A earned? 20,000. How? 70,000 is the net asset of the subsidiary at the end of the year, minus 50,000 net asset at the beginning of the year, and in this your share is 90%. So you add 18,000 to this. See, I showed you one consolidated format, no? In that consolidated format, there were 3 elements. One is parent, one is subsidiary, one is consolidation adjustments. This is coming from the format number 1, and this is coming from the format number 2. 3 we don't have any. Have they told you any fair value adjustments, upstream, downstream transactions? Not, they finished. And when we do this for 4, like we have to go for B, C, and D. Yes, we get a consolidated profit. How much? Students, please pause the video and work out. Yes, so how much did you get? 2,25,000. See, in this question, this is after 103. The first leg is 103 always, where you calculated opening balance of NCI, opening goodwill. Then in this, they asked you closing profit. Closing profit will start with the parent's profit plus post-acquisition share of the subsidiary. How did you get the difference between opening net assets and the closing net assets into your respective share? NCA doesn't come in. NCA is one more column. And you say that this is your other equity balance. So in this 110, this is what we are supposed to do. At the end of the year, we are supposed to calculate. And see, this question came in May 18. See, I will tell you one background of this question. It is a simple question actually. You will ask, this question came in the examination. The background is, when the new syllabus came in May 18, you had Ind AS also, accounting standard also. Yeah, you had both. In the new syllabus of CA Final, you had accounting standard also, few of the accounting standards like consolidation and all. In your 7 volumes were there of study material. Now, in consolidation, you had got a concept of a minority interest. Here we call them NCI. That is accounting standard language. Accounting standard language. Now the problem is, in accounting standard, for an NCI, when it becomes a negative balance, you stop. But in Ind AS, that's what I told you in my chart. Even though NCI is negative, you should continue allocating. Now this question came where you had that negative loss allocation. Now some students must have got confused there, because they had both accounting standard also, they have to study Ind AS also, and Ind AS is the first time, brand new. Just like multidisciplinary is coming, no, upcoming, brand new. Like this Ind AS was brand new at that time. So probably somebody might have left it. Otherwise, if you see this question, it is a very simple question. You see, A Limited acquired 70% of the B Limited on 1st April at 10 lakh rupees, where your equity capital and other equity was 10 lakh 80 net assets. In the 4 consecutive years, you suffered badly 2 lakh 50, 4 lakh, 5 lakh, and 1 lakh 20. And after 5th year, you experienced a turnover of 50, and then you started to make a profit of 1 lakh and 1 lakh 50. Show the NCI balance and goodwill at the end of every year. For this, first time I need to calculate. Assume the assets are at fair value. That means whatever these values are there, it is at a fair value. So step 1, I'll calculate the goodwill. What is my goodwill? Goodwill, purchase consideration, 10 lakhs. NCI, yes, Dhanashree. Sorry, 2,16,000. Anybody else? Any other numbers? Yeah. How much is my NCI? Sorry? 4 lakhs. 2 lakh 28. 3 lakh 24. See, how many different answers? Huh? In exam also it must have happened, no? How much is my NCI? Yes, Vishnu Priya. I actually left this type of questions at the beginning, thinking this is very simple. Yes, Vidya, how much is my NCA? 3,24,000. Yes, Vidya, same answer. Vidya, confusion? Yes, it is 3,24,000 minus fair value of the net asset. It's simple, right? No confusion there. Because they said fair value and your net assets are one and the same there. If it was different, you would have taken that values. So you got 2,44,000. In every single consolidation, this is what you need to get. Why? Because you need this value and you need this value. Because nowhere in a standalone you will find these two numbers. From here your journey begins now. Sorry? Yeah, but they said here, if the question is silent, then you will assume fair net assets itself is the fair value of the net assets. No? That's why I'm telling you, see here, you should feel happy when you find say this type of question, because if the fair value was different from this, which generally in all our 1 or 3 question it was different, then you will end up with the fair value adjustments, depreciation adjustment, deferred tax adjustment. That's why they don't make your life that much difficult. Generally they say that what they acquired, fair value is equal to its book value. Life becomes little easy. Clear? Yes. So now, did they ask me this? What did they ask? End of every year. So I will prepare a statement. I call the last column as cost of control. Some students might have wondered what is cost of control. It's also known as control premium, and it is also alias goodwill. Same, different names. Like Don had different names in different country, no? That Don movie. Now, like this, goodwill is also known as control premium, cost of control. See, they may use this English language to fool you. Spend time, understand what they are trying to tell you. If you misinterpret, you may doing miscalculations. So, on 1/4/2011, what is your opening balance? 3,24,000, and goodwill is 2,44,000. You finished 1 year. We call 2011-12. Did you made any profits? No, loss. So, what is the share of loss? 2,50,000 is the loss. Out of that, 30% you give to them into 30%. Will you give here? No, this is not a CONPL column there. This is a goodwill column. Goodwill will not get touched with your loss. Remaining will go to my consolidated P&L. But they didn't ask me, see, in the previous question, they asked me what is NCI, what is goodwill, what is consolidated P&L. In this question, they asked me only NCI and goodwill, not the consolidated. If the consolidated P&L also asked one more column, I would have drafted, and that 70% of this 2,50,000 would have shown, I would have shown here. Entry, there is no entry, because this share of loss we got by consolidating one by one item. It is a net effect. It's not like investment in associate, you pass entry in loss account debit to investments. Here, line by line consolidation happens, no? Only 2 adjustments. If you come to know third adjustment, please tell me somewhere. Then what happens? You got a closing balance how much? 2,49,000, 2,44,000. Then again 2012-13, yes. Impairment? They didn't tell you, no, in the question. If they tell you, you would have charged it. That loss is different, Dhanushri. That loss is your operational loss. Impairment is coming from your CGU by adding, if there is an indicator that there is a business loss and all, you find out the present value of the future cash flows, recoverable assets, that activity you are going to carry out. Yeah, very good. See, I wish you asked me, because this type of doubt should not come to you in the examination hall. Because somebody may misinterpret, no, oh, this loss itself is my impairment loss or something like that. Or by mistake, somebody could have taken 70% share here, which is meaningless. You understood now why we are doing what we are doing? So in 2000, share of loss was 4 lakh into 30%. Balance became 1 lakh 29. In 2013-14, share of loss is 5 lakh, 1 lakh 50. 13-14, it's 1 lakh 50. You get a negative balance for the first time. Now in accounting standard, this negative balance was not shown, so you should show dash, and this entire loss was allotted to the parent, and this was kept a track in separate ledger there, separate paper. And next year when you earn profits, first of all, have you done this loss making associate? Loss making associate, have you done that? So we keep the track of how much loss is unallocated, and the day profit comes, first we assume that loss. Then the same thing would have done. But here there is nothing. You straight away go on. Every year you adjust. Then you'll wonder what type of question is this. Should not people solve this question when it comes in there? People should jump. But the problem is, there are so many things there. Accounting standard is there. Some misinterpretation can happen here. Okay, students, so please pause the video and tell me the closing balance on 17-18. Yeah, your question is valid. How students will come to know whether Ind AS or this, because the word non-controlling interest itself says that this is Ind AS. So you proceed further, you do all the adjustment. Again, students, see, it's a very simple question. Students would have done, got full out of full here, 8 marks, and that too without spending much time. So the closing balance is 33 and 2 lakh 44. Next question, a small question. With this, we are done with the adjustments. R Limited hold 80% stake in Y, and Y also issued 10% cumulative preference shares. Similar thing we have done in Ind AS 28 also. To the non-controlling interest. That means out of 10 lakhs, you are not holding anything. Okay, in the previous question, no mistakes, no? So R has got 80% of Y. Y 20% by NCI. Now Y also has got preference shares, which is cumulative. None of these investments are done by R, somebody third party. During the year, Y earned a profit of 5 lakhs. Then you say that in the 5 lakhs, we will distribute 80% to them, 20% to NCI. Y earned, no? However, you have not declared any dividend, but the problem is these are cumulative preference shares. So can you distribute 5 lakhs? No. In that 5 lakhs, 10% you make a provision, and then 4 lakh you distribute to R and NC. Same question we have done in Ind AS 28 also. Same cumulative preference shares. So if there also, when I take my share of profits, I have to take net of cumulative preference shares dividend, because they are cumulative preference. If it was not cumulative, you would not have deducted it. Not required question. Just one concept for you, and I am telling you it's not an examination question. One concept there, because they may include this in somewhere. No, they said how profit is attributed to R. No, and they said 80% stake is acquired. That itself shows you, see, you are not even 103. Why? Because profit attribution happens at 110 subsequent to consolidation. Clear? Yes. So with this, how much profit you will get? 3,20,000. Yes, with this we have done all the special adjustments related. So next thing is the consolidation problems. Yes, take out question number 36. This is a very small, simple example to explain you the logic behind consolidation. It should not take much time. Given below is the balance sheet of P and S at the end of the year, 31st March 2011. Oh, some at 31st March it is given. So they have given assets, liabilities, equity, etc. On 1st of April 2011, P Limited acquired 90% of S Limited for 2 lakh rupees. The fair value of the net assets is 2 lakh. Immediately you check S Limited one day before 31st March. What is your net assets? Same. Good. That means there is no fair value adjustments. See, when you acquired S, what is their fair value of the net assets? 2 lakh. You go to the balance sheet and say 3 lakh minus 1 lakh, 2 lakh. So fair value of the net assets and book value of net assets is one and the same. That means it is the same, that ABCD subsidiary. You feel very good. That means there is no fair value adjustments. If it was different, no fair value adjustment would have been there. Your depreciation, inventory, God knows all things. Now the company adopted a policy to measure NCI at a proportion net asset. So very good, 10% into 2 lakh gives you your NCI opening balance. With this, we could have done 103. Agreed? And if I had have told you 103, and if I had have told you prepare opening consolidated balance sheet, you would have added both the values because it is the fair value only, no? Fair value and book value is same. You would have added here. You would not have taken equity and reserve. You would have taken this and you would have calculated goodwill and NCI. Balance sheet would have tallied. So for me, goodwill working is important. Second, during the year, P and S made a profit of 1 lakh rupees each. So at the end of the year, they have given you the balance sheet. Look, what is their opening equity? 5 and 1. End of the year, it became 6 and 2. Profit. Where is another leg? Net assets, not fair value. If your profits, you have earned the profit, one leg will sit in the other equity called retained earning. The other leg will be distributed among different assets here, assets and liabilities. You cannot pinpoint and say. That's why you prepare a statement of P&L, no, to give the breakup. But if this profit of 1 lakh came from where? If you see opening asset was 5 lakh, closing asset is become 6 lakh, current assets is 4 lakh, closing current assets is 2 lakh. And at the same time, there was in the opening investment, there was no investment. At the end of the year, there is one investment in S also has come 2 lakh. So net assets has become upper niche. Net effects of net assets is 1 lakh. That's nothing but your profits. Now prepare consolidated balance sheet at the end of the year. What you need to do is not at the beginning. At the beginning means 103. So I told you there are only 2 steps you have to keep in mind if you want to prepare at the end of the year. Step 1, calculation of the goodwill. Goodwill. Purchase consideration is how much? 2 lakh. NCI. $20,000. FVNA 2 lakh. So your goodwill is 20,000. Yes, step number 1 is goodwill. Always, whenever they ask you, whether at the end of the year, end of the second year, 4th year, and after 10 years, whatever, you have to go back on the date of acquisition. What was your goodwill and which method of goodwill valuation you had done? These 2 important things you have to do. Then I told you second working is always your other equity. So have 2 columns called other equity and NCI. In my format, the starting is opening balance of NCI. How much? 20,000. Then I will go to the P&L. I will go to the balance sheet of parent. I will say opening balance of reserves. Now, how much is opening balance of the reserve? 5 lakh, no? Parents of P Limited. P Limited opening balance, where you will find? In the opening balance sheet. Did P Limited made profits? Yes. Add profit for the year. How much? 1 lakh. That is subsidiaries profit. Now I am talking profit of P Limited. Now, yes, we have done with all the items. Is there any P declared dividend? Did P pay in dividend distribution tax? Did they receive dividend from the subsidiary? Nothing. Just leave, finish, we are done. Now let us go to the subsidiary part. Did the subsidiary earn profit? Yes. So add share of post acquisition profit. How much profit did B earn? S earn? 1 lakh. How much you will take? 90,000. How much you will distribute to NCI? 10,000. Did the subsidiary declare dividend? No. Is there any other item related to subsidiary OCI items? No. Is there any fair value adjustments? Is there any impairment of the goodwill? Is there upstream, downstream transactions? Done. Right? Total 6,90,000, 30. Done. That is 1 lakh. That increase and decrease in the assets and liabilities happening, no? That net impact is 1 lakh, which is your profit for the year. That's why if you take subsidiaries difference between your opening balance sheet and closing balance sheet, which we call net assets, is nothing but a profit. So if you see individual asset, no, you might have purchased fixed asset, you must have sold something, debtors might have increased, stock must have reduced. You can't trace it. The net effect of all this, you must have taken a loan, you must have repaid a loan, you must have taken one something on security deposit you might have paid. Net effect of the net asset between opening and closing is your retained earnings. This is what your economists, no, Alfred Marshall and all told before profit and loss account statement came. The difference between your opening net asset and closing net asset is your profit. This is real profit. Clear? Done. Chalo. In my format, there is nothing which is appearing there, but no, nothing they have told. Intercompany eliminations, nothing. So straight away go to the balance sheet. You want to see the previous one? That's it. There is nothing here. Only one item. I told you, one problem, we'll solve it on a very simple, plain example, so that I will make you understand what exactly consolidation is. I start with the non-current assets. How much is my non-current assets at the end of the year? So 6 plus 2, 8 lakh. I'll take their assets, my assets. What I'm supposed to take is fair value of their assets, but fair value adjustment was not there. Otherwise, for this plus fair value adjustment on the acquisition date, I should have done minus depreciation on the fair value. No, so tell me again. Nothing that we cannot trace, nothing, because that is going to up and down is going to happen in the fair value. Suppose on the date of acquisition, when you calculated goodwill, this FVNA, fair value of the net asset, did you take over more than the book value or at a book value only? That's why closing book value also same. You will take the closing book value. But if the opening goodwill calculation you have done, say book value was 100, you would have taken it 150, that 50 rupees you would have added here. Minus on that 50, 1 year depreciation you would have deducted. Why? Because that fair value increase is not there in any of the standalone statement. It is there only for your consolidated statement coming from 103. How can you leave that? Because you take the opening balance of the goodwill there. That means fair value adjustments are sitting in the goodwill. Other like you cannot leave, no. That's why we will add it. You asked me, what is the journality? I cannot tell you the journality because I have to just simply go and add it here. Because the cumulative adjustment is sitting in the goodwill there. Anyhow, I'll show you. Oh, okay. So what is my book value? 100 is the book value. Can I assume 100 to be the book value? Fair value? They will not tell. We have to do it because in CFS, always the closing balance should be at a fair value. Because I took over the subsidiary at a book value. No? So in CFS, parent will be always at a book value. In CFS, parent will be always at a book value, subsidiary will be at a fair value. But what I take from the balance sheet is the book value. Whatever in the examination question, they will give you on balance sheet. Is it fair value balance sheet or book value balance sheet? Book value at the end of the year. So take that, add the opening fair value adjustments, if at all you have done. Opening means at the time of 103, have you taken over it more than the book value? Say book value was 100. Did you take it more than 100? Say you would have taken it 150, no? So add 50 there. Any of students, leave it. If you are getting confused. Next question, I have got one more example with fair value. I'll tell you there. Let us continue now. Okay, what is the second item? Sorry? Investment I have to eliminate because that's what I told you, consolidation procedures. So how much is my goodwill? 20. Is there any impairment at the end of the year? No. Impairment is not there, no. Otherwise my goodwill would have come down. Next, what is my third item? Investment is there. Investment is not there. Then we have got current assets. How much is my current asset? 3 plus 2, 5 lakh. So I got a balance sheet total of 13 lakh 20,000. See, every question we need not interpret like this. Only 1 and 2 questions I will explain you in detail where it is coming from, because you will simply get mad now if you sit and find the reconciliation and all. Only academic interest, 1 and 2 questions only we will sit and analyze now. Where it is coming, how my balance sheet tallying. Otherwise, unnecessary exercise, right? You should go like a machine gun straight away. I'll give you a format. With this, I hope you have understood that format. If no, please go home, practice it, ask me more questions. But next, when we solve big questions of exams, I don't want you to sit and think there. Oh, how is this my balance sheet tally? You should know it. Okay, done? We'll go to the liability side now. Equity share capital. How much is my equity share capital? 3 lakhs, because I am not going to take subsidiaries equity share capital. That I didn't take during consolidation 103 only. Other equity, what all items I have got? 6 lakh 90. Working note number 2. Did I got this? NCI, on the face only I will show. How much? 30,000. Liability, I have got 2 lakh plus 1. Done. Balance sheet tallied. Now, did you get this balance sheet tallied? Can you tell me how did this balance sheet got tallied? Wonder, no? So many adjustments. Some goodwill you brought from nowhere, closing assets you took, profit you distributed. How on earth the balance sheet got tallied here? See, NCI came from nowhere. Where is the second leg of this NCI? God knows. P&L. Okay, I'll just show you, okay, how this balance sheet got tallied. We will discuss this more in another question also. To understand, see, there are these equations we need to know. The equation is net asset is nothing but equity plus reserve. And a profit is nothing but opening net asset minus closing net asset. This is what I started this chapter with. See, simple. If you have to do it, first of all, parent's balance sheet. Did you touch anything? Okay, so I will take parent's balance sheet as it is. Will it get tallied? Obviously, when you take all the item of the parent, parent balance sheet has to tally. Did you take anything extra? Yes. What did you take extra? Goodwill and NCI. In return for, so you get the opening goodwill entry incorporated. When you incorporate the opening goodwill entry, goodwill will come, NCA will come, net assets will come. What goes out? Investment will go out. Then replace the opening net assets of the subsidiary in that goodwill entry with the closing net assets. What is the difference between the opening net asset of the subsidiary and the closing net assets? Profit. That you distribute. Finish. Balance sheet should tally, no? And this is what we did. And if you have got a consolidation adjustment, give two differences, two legs. Okay, I'll show you. First, you should tell me. I will go to the parent's P&L. What is my equity share capital of the parent? 3 lakhs. Okay. How much is net assets of P? Other than investment. 6 lakh plus 3 lakh minus 2 lakh. This is, I'm talking from the closing balance sheet. P Limited's closing balance sheet, you look. How much is equity share capital? Other than investment. I'll show investment separately. So 6 lakh is the assets, 3 lakh is the current assets, 2 lakh is the liability. So you have got 7 lakhs, correct? How much is the investment? 2 lakh. I will write inside column. Now, do you have anything else? Other equity is there. In other equity, how much is the opening balance of reserve? 5 lakh. Add profit for the year, how much? 1 lakh. So how much do you get? 6 lakhs. Did my balance sheet tally? Tallied, no? Tallied, no? That means what I did in the first step, I took parent's balance sheet as it is. Anything I'll do, any time of consolidation, parent's balance sheet is not subject to any adjustments. Okay? Now, what I did, I have taken goodwill. That means I have incorporated opening goodwill. Do you have the opening goodwill entry with you? Goodwill calculation is there. Okay. What is my entry? I will change the color here of the pencil here. I'll say goodwill. How much is my goodwill? 20,000. Then opening net asset of subsidiary. How much? 2 lakh. Then opening NCI. How much? 20,000. And to what? Investment. Did you prepare the goodwill entry, what was the journal entry for that? FVNA 2 lakh, goodwill 20, asset side, to NCI, to investment. So I will say minus investment 2 lakh. To investment means minus. No, already in the parent's balance sheet when goodwill was there, investment was there. I will remove it. So how much my investment became now? 0. That's why you didn't in the CFS, you didn't show any CFS. Did my balance sheet tally? Tally, no? Okay. So if I take the balance sheet total 7 plus 9 lakh 20, here 6, 9 lakh 20. My balance sheet tallied. Third step, will I show opening net asset of subsidiary? Meaningless. This should be replaced by what? Closing subs. So I will minus this, minus opening net asset 2 lakh plus closing net assets. How much is my closing net asset of the subsidiary? 3 lakhs, correct? So plus minus 0, I'll show 3 lakh here. Agreed? See, because of this 1 lakh difference came in my balance sheet. That profit is share of profit. In other equity, 1 lakh, did you distribute, add profit of subsidiary, which is nothing but difference between 2 and 3? How much? 90 plus share of profit of this thing, 10,000. You got the balance sheet. Check these numbers in your balance sheet. This is my CFS. In CFS, NCI you showed 30, other equity showed 6 lakh 90, equity share capital you showed 3 lakhs, net assets of the parent you showed 7, goodwill you showed 20, net asset of the parent together with N subsidiary you showed 3. Finish. That's why if there was a fair value adjustment, you will simply add a fair value adjustment because the second leg would have been sitting here. So there are 4 steps. 1, I will take the parent's balance sheet as it is. Step number 1. Definitely my balance sheet should tally. Step number 2, I will take the opening goodwill entry off because I have to add show these 2 values. So I will take the opening goodwill entry of the subsidiary. But the opening goodwill entry will end up with the opening net asset of the subsidiary, which is meaningless for me. So opening goodwill net assets I will replace with the closing net assets from the balance sheet of the subsidiary. But the difference between opening net asset and closing net asset is the share of the profit or OCI during the year. Add it, you got it. From now onwards, anything like goodwill impairment, I will reduce goodwill, I will reduce profit. Upstream transaction, I will reduce inventory, I will reduce profits. Going forward, anything after this, I will have two legs. Understood? Are you clear? Nice, no? Yeah, see, that's why this is only for our academic interest, because once you understand about how it works, now it becomes very easy for you to understand the format which I am going to give you. Going forward, there is one big format. I'll ask you, okay, is this there? Is this there? In fact, when we are showing that, it's actually a debit and a credit. One leg will for me, one leg for NCI. The second leg would have been somewhere here. But sitting and reconciling is a big task actually. That's why in a simple format, I showed you how it works. Prithvi, clear now? Yes. Next question will be with the fair value adjustment. Same story. How the fair value adjustments are going to affect, that we will see.